Hey guys, Toby Mathis here, and today we're going to go over the 2026 tax brackets. They've been adjusted for inflation along with things like your 401k contribution amounts, the IRA contribution amounts, the HSA amounts. By the way, we have this handy dandy reference guide that I'll put in the show notes that you can absolutely go in and download so you get all the numbers of what's going on for 2026 because it's all been out there. Let me give you an example. So they adjust these numbers every year for inflation. And so our standard deduction, what comes off the top, for a single person is $16,100 for 2026. Married filing jointly is $32,200 for 2026. Now just remember, there's no more personal exemptions. Those went away under the Tax Cut and Jobs Act, and they're now permanently gone under the One Big Beautiful Bill Act, which made the Tax Cut and Jobs Act provision permanent, so like gone. So all we're doing is we're figuring out what tax bracket, what my taxable income is, subtracting off that standard deduction or your itemizing, whichever one's greater, and then we can figure out what tax brackets we're going to fall into. And I'll give you a step-by-step framework that you could follow because there's an adjustment that happens, there's something called stacking that happens, and I'll go over that in just a little bit. But how do tax brackets work? So I had a client say, oh man, I made a little bit too much money this year. I'm in the 22% tax bracket. I just cost myself a bunch of money. And that's because they have a mistaken belief of how the tax system works. So let's just do a pop quiz, right? Let's say that you made $80,000 and you're in the 22% tax bracket. How much do you have to pay in taxes? Is it $17,600, which is 22% of that 80, or is it less? Well, let's explore that, and I'm going to go over the buckets. So when you have a tax bracket, a graduated system, the way we have it, these are the tax rates underneath our tax code. And what happens is your money goes into here and fills up this bucket. So your income, so your wages, everything that you're making, your W-2, your business income, interest and dividends, rental income, any other income fills up that bucket after you do adjustments and after you do your standard deduction or your itemized. And I'll go over that in a second, right? But whatever it is, our taxable income flows into these buckets first, fills up that 10%, then it overflows and goes and starts filling up the 12% bucket, then it flows and starts filling up the 22. The amount that you pay never exceeds 10% of that amount. So let me give you an example. I'm just going to pull up the tax code for 2026 or the tax rates. And let's say that for an individual, this bracket is if you're making $0 to $12,400, which means you would pay 10% of that. It's always going to be $1,240, period, in that bucket. If we go over to the married filing jointly, it's roughly twice that. It's 0 to $24,800. So you're paying $2,480 for that bucket. That never changes. As you continue to make money, it flows into the next bucket. So let me use single. And the next bracket, for example, is $12,401 to $50,400, which means there's that 12%. So you would add $1,240, and if you filled up that entire bracket, that entire amount, you're going to be at right around $5,800 total when you add up both buckets when you get to the top. That's how brackets work. The more you make, that additional income gets taxed at that higher amount. So it just keeps on going until you end up at the very top bracket, 37%. You end up having this, for a single, for example, you're over 640,000. Anything over 640,000 we already know what the tax is because we can add up all the buckets before it. It's $192,900. So we can just say, here's how much tax you're going to owe. Sorry to be standing in front of it. $192,979. Right? We already know, plus 37% of whatever amount is over that bracket, which is $640,000. I'm just going to write that. 640, what is it? 601. So anyway, the brackets, you can just go ahead and download and grab, and you can see what each of the brackets are. But the way it works is we can figure out the amount that we owe for each bucket as we continue to flow into the other bucket. Another thing to know is something called stacking. And with stacking, not all income is taxed the same. There's long-term capital gains treatment on things like dividends or capital gains or capital assets that you've held for at least a year. And that is 0, 15, or 20% depending on the income. And I'll show you how that works here in a second. So what are we talking about? We're going to go, and I'm going to say there's basically 5 steps that we look at. And I'm just going to write those here. Step 1 is you earn it. We calculate how much we've made. Step 2 is we adjust. And what are adjustments? Those are things like IRA contributions, student loan interest, things like that. I'll go over that again in a second. Then we use our deductions. Step 3, deduct. Step 4, we stack. And what stacking is using your capital gains rate on the capital, on the gain that, or the income that's attributable to capital gains. And we're going to figure out what that tax bracket is. And then at the very end, we figure out what tax bracket the various dollars fall into, and we tax it. Tax it. So we earn, adjust, then we deduct, then we stack, and then we calculate our tax. In that order. I know it sounds crazy. I'm going to walk you through it here, but this is exactly how it works. And so I'm going to go through each step in painful detail with you, and then I'll go over some examples with you just to make it make sense so that you understand exactly how it works. All right, so let's start with the earning amount. You start with all of your income. And this is everything you made during the year. We go from January 1st to December 31st. Anything you make is going to fit into this category. So, common, W-2 wages, your business income off of Schedule C or on page 2 of your Schedule E, K-1s, things like that. Your interest in your dividends go here. Your rental income comes onto here. And any other income that you have goes into this first step. So your earn bucket is, we're starting with your income. And this is called gross income. So when you hear the term, what is your gross income? That's not your taxable income. That's not even your adjusted gross income. That's your top line. Your gross income is what you're making, is the top line. We haven't done anything with it yet. Then we adjust your income. And by the way, nothing is taxed on that. We have to do these next 3 steps before we even get down to the actual tax. We have to do them, and this is why it's so important to know this stuff, guys, because we don't know what your tax rate is until we walk through these steps. Your accountant does this by punching it into a bunch of software, but you should know exactly how it works so that you know where the opportunities are to make changes to lower your tax rate. So the number 2, so we figure out the gross income, and then we adjust it. And the adjustments, by the way, these will lower your income above that line. So our adjustments are our retirement plan contributions. And this is things like a traditional IRA, a SEP, solo 401k. This is your HSA contributions, the triple threat, which is so huge, the health savings account, your student loan interest, and even certain self-employment expenses will go into these adjustments. Then you get something called your adjusted gross income. So if I was going to just kind of write this, this is your gross, this is your AGI, adjusted gross income. And this, again, this is why it gets so interesting. A lot of people use that term AGI because a lot of benefits start to phase out based off of that number. But if you can lower that by doing these things like HSA and retirement plan, then you realize, wait, I can move myself out of the phase out? Yes. And that's why people use things like defined benefit plans, cash balance plans, 401ks, IRAs. And by the way, if any of these are, hey, I don't understand what these terms mean, subscribe to this channel. I go over this stuff in sometimes this type of detail, or come to our courses. We teach, not only do we teach the tax and asset protection workshop almost on a weekly basis, a couple times, sometimes 3 times a month. We do them live, and then we also have Tax Tuesdays, which are live every other Tuesday. Just go to Anderson Advisors or click on the show notes, and I'll put links to all these things. Just start to learn it, and you'll understand what the vernacular means. Step number 3 is to take your deductions. And this is where we can reduce our income by taking things like our standard deduction, which is the $16,000 or $32,000, given, plus some change. That is available as your standard, or you're itemizing. And when you're itemizing, you're doing things like your mortgage interest, your SALT limitation, your state and local taxes up to $40,000. There's a phase out there, but the one big beautiful bill made that huge. Your charitable giving gets put onto the itemized, and so if in your medical expenses that exceeds 7.5% of your adjusted gross income, there's that term. You have to know your AGI, then we can figure out what we can deduct. That's why you have to do it. And that leaves you with your taxable income. And so after that, I'm just going to call it TI, because that is your taxable income. And this is the number that starts to go into the brackets, is we're looking at our taxable income. But this is where stacking comes in. We have to calculate our capital gains separately. I know you're like, oh gosh, this gets confusing, right? All we're doing, and I'll walk you through a couple of examples, is if you know what your capital gains are, which you're going to get a statement of what your capital gains are, then you would just back it out and you would calculate that out separately. Because capital gains are not taxed first, they're actually calculated after your income, your taxable income is known. And that's why we call it stacking. So here's what happens. Your ordinary income, the stuff from like your W-2 non-capital gain income, is calculated first. Then your capital gains are stacked on top. And those long-term capital gains rates are 0, 15, or 20%. And let me show you how this works. I'm going to grab the actual rates so you get an idea of what they are. Okay, so for single filers, for example, the first $49,450 is 0% for capital gains. So long-term capital gains, you're at 0% if you're in these buckets. And by the way, for stacking, it can flow into another bucket. So if your income is $25,000 and you have $25,000 of additional capital gains. So if our ordinary income from wages, let's just say, net it out after you figure out what your taxable income is, and half of it is your ordinary income and half of it is long-term capital gains, then you're going to have $25,000 going in to these two buckets. You're going to have the $12,400 at 10%, which means $1,240. Then you're going to have part of it flow into the $2,400 to $50,000 bucket, and it's going to be taxed at 12%. So a portion of it will be taxed at 10%, and the rest will be taxed at 12%. Then we stack on our long-term capital gains, which is another $25,000. So we are just going to barely move into the next bracket, which is the 15% bracket for long-term capital gains. Only that portion that exceeds $49,450. So we take the $25,000 of ordinary income, we add on $25,000 of long-term capital gain. A portion of that $25,000 is going to be, of the long-term capital gain is going to be taxed at 0, and then about $600 or so is going to be taxed at 15%. In that 15% bracket, let me just write this down here so you have it, is $49,451. And again, download your sheet so you can just kind of follow along. It's on the top of the second page. To $545,500. That's the 15% bracket for long-term capital gains. Anything above $545,500 is in this 20%. And I'll get out of the way so you can actually see that. And I'm just doing the single. Apologize for everybody who's married out there, but it's just basically it's almost you would just use the married filing jointly bracket. But that tells you from the standpoint of single filers where you end up in the 20%. So a big, huge chunk for almost 90%, 90+% of everybody out there, a huge percentage, you're going to be in that 15% long-term capital gains bracket because you're going to probably phase out on average. Single, but the married, let me just do the married so you kind of can see how that works. Married is going to be 0 to 98,000. 98,900 is going to be the 0%. The 15% is going to be, oops, so 15%, pretend that says 15%, is 98,901 to 613,700 is the 15%. And then anything above the 20% is anything over $613,701. So again, you figure out what brackets you're in on your ordinary income, then we stack on the capital gains. And by the way, this is why a lot of people have an accountant, because they figure this out. You should know, though, that this is how the process works. So you do your stacking, and now we know. Now we can apply, we can figure out which capital gain bucket they fall into, how much ordinary income you have, and then you get to apply your tax bracket. So ordinary tax rates is part of your taxable income, and then capital gains goes to your capital gains bracket. So we have to use them in tandem to figure out what our rates are. And then we get to subtract off any payments that we made, because now we know we did the stacking, which is really where we do our capital gain. Then we can figure out what our tax is. We have to subtract off any credits that we have, child tax credits, solar credit, energy credits, things like that. Amounts that we've paid in. So if you have payroll, you get to apply all those, and so you get to figure out what the withholding is from your paychecks and your estimated tax, and that'll tell you which amount you still owe. So let's do an example. I'm going to verbally tell you this example. So it is really simple. We have a single taxpayer. They're making $70,000 of earned income. They make $10,000 of long-term capital gains. And so let's do the calculation. We're going to follow it exactly. So we have $70,000 of earned, $10,000 of long-term capital gains. So step number one, let's do step number one. What do they have that they've made from a gross income standpoint? So that might be, in this particular case, here I'll just write down here, that's going to be $80,000, right? They have 70 plus 10. Then we adjust it. Let's say that we have $5,000 of HSA and $5,000 of a traditional IRA. So we do 5,000 HSA, 5,000 IRA, and that's our first adjustment. So step number two is to do our adjustment. So what is our adjusted gross income based off of that? Our AGI under that is now $70,000. So we know what our adjusted, that's our first big thing that we do. That's our first reduction, is now we have 70,000. Now we take the standard deduction, or we take whichever's higher, the amount of our itemized deductions or our standard. Let's say that you're like 90% of people. This is based off of last year's numbers. Right around 90% did the standard deduction, which means you would get a standard deduction of 16,000. Let's just, again, I'm saying that this is a single person. So our standard deduction is 16,000, is it 100 for 2026? So you would subtract that off, which gives you taxable income. Our taxable income under this scenario, we take this off, and so our taxable income, let's just say I'll do it for you real quick, would be 53,900. So again, I know I'm verbally saying it, I'm trying to write it down, but it's 53,900. That is the key number. That is our taxable income. But remember, we have to separate out the capital gains from the ordinary income. How much was our capital gains? If you remember, we had 70,000 of W-2, we had 10,000 of long-term capital gains. So we would separate it out, and we'd figure out, okay, our big numbers for this, and I'll write this over here so you can kind of see it. Our big numbers are going to be 43,000, $900, that is our ordinary income. 10,000 is capital gain over here. So our stacking it is going to be 43,000. That's going to go into these buckets, and it's really simple. Our first 12,400 is going to be at 10%. And then we're going to have the difference between that. Let me see if I have those numbers written down here. So yeah, so there's a remaining, it would be 49,000 minus the 12,400 would give us 31,500. That is taxed at 12%. So that tax would be $3,780. So our ordinary tax, the total amount of ordinary tax on this amount is calculable. It's $5,020. Then, and by the way, they never even reached the $22,000 of, or 22% bucket. They stayed in the 12%. And then they also have this $10,000 that we have to figure out, and so we have to figure out where that flows. So we put it back in here, so we know that we are, the 0% goes up to $49,450. So we're going to be a little bit beyond that. So how do we figure this out? Well, the first $5,500 of capital gain, the difference between this and the top bracket, which is here, 49,450, is going to be at 0%. So the first, I think that is right around 5,550 is 0% capital gain, and then the remaining portion, which would be 4,550, I think, would be in the 15% tax range, which would give us a total tax of, let me figure out the number, it would be $667.50. So there you go. You can add up 600 and the 5,000. So when you end up doing the math, it's $5,685 total tax on 80 grand. Remember we said 80? Most people would immediately go and say, oh, you made $80,000. I'm going to be in the 22% tax bracket. You're going to end up paying, 15 grand in tax. No, you're not. You're not, or 16,000 or whatever number it is. When you actually go through the steps and you first, you figure out what your taxable income or your gross income is, then you adjust it, then you deduct it. That gives us our taxable income. Then we can use the brackets. Then we know what our tax is. And in this particular case, we end up being just under $6,000. It ends up being $5,687, which I think is right around, probably around 7% total tax rate. That's why it's really important to look at what's your graduated rate, what's your total tax, what's your total tax bracket, what's your total tax rate. It's usually a lot less. All right, let's do another example. And I'm just going to do this one verbally. Let's say that you're married filing jointly, and your husband makes $100,000, wife makes $100,000. These are W-2 jobs. And then they have another $50,000 that they made, let's just use $200,000. Make it simple. And then they have, let's give them some income from NVIDIA. They bought NVIDIA and it rocketed up. And they made $50,000. They held it for 3 years, so it's long-term capital gains. So we would do all of the things that they might do during the year to lower that. First thing comes to mind, and they're making wages, is they're probably going to do a 401k. Second thing that might come to mind is doing a family HSA. Let's assume they have a high deductible plan and they contribute to an HSA. So let's do, husband contributes $10,000 of his wages into a 401k. Wife does $10,000 of her wages into a 401k. So they have a total of $200,000 of wages, and they contributed $20,000 into a 401k. But then they also make a family HSA contribution of $87.50. So let's do our steps. How much did they earn? They earned $100, $150. So their gross income is $250,000. So that's number one that we know. But nothing's taxed yet. First adjust, then deduct, right? So our first adjustment is going to be to figure out the 401k contributions. It's $10,000 each, so $20,000 is coming off the top. The HSA comes off the top. So our total adjustments, $10,000, $10,000, $8,750. That sounds like $28,750 total adjustments. That gives us our adjusted gross income. So our adjusted gross income is we take our total taxable income, our gross income, and we subtract off the adjustment, which will get us to $221,250 is our AGI. It's our adjusted gross income. That gives us this number right here. Now we have to do our deduction to get us down to our taxable income. Well, in this particular case, married filing jointly, I didn't give you any facts about charitable donations and things like that or whatever, so we're just going to ignore that. We're going to take the standard deduction, which is $32,200. So that's going to be $22,250 or $221,250 minus the $32,200, which will give us taxable income of $189,050. So we take, remember, we're taking our adjusted gross income and we're subtracting off the standard deduction. It gives us taxable income of $189,500. But now you know we have to stack it. How do we do the stacking? We're going to figure out what portion of that $189,000 was long-term capital gains or capital gains of any type. If it's held for less than a year, it just becomes ordinary income, so there's no difference. But if it's long-term capital gains, we really care about that. And so we do the separation. And what does that mean? We're going to take the $50,000 and we're going to subtract it from the other income. So our ordinary taxable income under this scenario is $139,050. That's what's going to go into these buckets, and it's going to start to flow down. It's going to start up here. We're going to fill this up pretty quick. It's going to go down here. We're going to fill this up. So it was $139,000, and we're going to end up down here filling up a portion of our 22%. And we're going to have 3 buckets that we have money flowing into. So we would just do the first bucket. We already know that this amount can be calculated. It's 10% of up to $24,800, so it's $2,480. Then a portion flows into the 12% bucket, And we would fill that bucket up, which we already know that bucket, when we do the calculation, ends up being $9,120. And then a portion of it is going to flow into the 22% bucket. And that total amount would be about $38,200 in this example. So the tax on that would be $8,415. So each bucket, you figure out what the number is. So we have in each bucket, using our math, we can say that under this example, we know that we're going to have a certain dollar amount. And this one's going to be $2,480. We add those up. So we add each of those three up, and that is going to tell us what our ordinary tax bracket is, which would be $20,015. We never even reached the 24% tax bracket. Most people, I said you made $250,000, you're immediately going, oh man, what tax bracket? You're gonna go right to it and you're gonna think 24%. You're gonna look at the tax charge and you're gonna say, that is definitely in the 24% tax bracket. I'm paying 24% on all that money. Nope, you're gonna be really surprised at how little you're actually paying. Because then we calculate the long-term capital gain amount. And we already know where we're sitting, right? We're already in that 22% bracket. So we're going to end up with our $50,000 in the, what would be the 15% tax bracket, which, really simple math, $50,000 times 15 is going to be $7,500. So we are going to add up our total ordinary tax rate, which we had was what, 20,000 and what do I have? I have it written down. $20,015 plus the long-term capital gain rate. So our total tax that we are going to be paying, what is that? $27,515. Not too bad. On $250,000, that means your actual tax rate, your effective tax rate, is 11%. And if most people, this is the magic number. Whenever I'm working with people, I'm saying, hey, kind of the secret sauce is to be right around that $200,000 mark. This is a great example. You could be making a ton of money in different ways, and if you use tax strategies to lower your taxable amount, that's great. But at the end of the day, when you get yourself into these types of brackets, your effective tax rate, your effective federal tax rate, I should say, because you still have to figure in your state income taxes too. I'm not purposely forgetting that. I'm just trying to use this as an example. Is your effective tax rate can be a lot lower than what you realize, because we're so ingrained as this thinking. If I make more money, I'm in a higher tax bracket. No. The more money you make might be taxable at a higher tax bracket, but it's really tough to get into those higher tax brackets. Now, some of you guys are looking at me going, Toby, I make $600,000 a year, W-2. Yep. Then it's really important to look at the adjustments that we can make against that and the deductions we can make against that. And those deductions, by the way, the standard deduction is one, but we also get to factor in our business losses. And so that can lower your taxable income as well. And that taxable income is that magic number after the deductions. Short-term rental loophole, real estate professional status, other business loss, all those things can lower that taxable income amount. Now you're starting to think right. And that's what it really comes down to. So I want you to, I'm going to say this really slow. We earn it, we adjust it, then we deduct it, then we stack it, then we tax it. We earn it, we adjust it, we deduct it, we stack it, we tax it. And so if you only look at tax brackets, you're going to miss the real story, right? The order of which we do these things is where the savings come from. And if you understand that, you are light years ahead of other people, and you're well on your way of doing some great tax planning. So by the way, awesome. I just want to say, if you've watched this for, here's the big bonus. I'm going to give you the tax chart, the tax cheat sheet we have. This is kind of fun, so you can kind of go through. It's the one for 2026 that just came out. It even has the life expectancy chart on it, so if you're doing required minimum distributions or things like that, or if you're just kind of morbid and you want to know, you can check it out. Just look in the show notes. I'll put the link in there. And for those of you who can't get enough of tax planning, like and subscribe this. I always put content like this out, and I'll put some links to some other great videos so you can continue to fill your brain with tax knowledge. Good luck, guys.